Man, I feel like I've barely been in the office. Ugh, it's traveling everywhere.
Yeah, we haven't done this in weeks. Our
I
listeners are
know.
starved for content.
It's
They want
true.
about your trips. They want about our session the last 2 days, planning for the future of the firm.
That was exciting. I think we have exciting stuff coming down the pipeline, which will be fun to see how the board puts everything together. I was in New York last. Um, no, I didn't hang out with Jamie Dimon, but I did hang out with people that hang out a lot with Jamie Dimon, which was interesting to hear from. They can predict the future just as well as we can, I found out.
Which is not at all or a lot.
Yeah, with zero consistency or persistence. Exactly. And guess what? I'm skipping town next week also.
Whoa. No talk your chart next week?
I'll do it. We can do it early in the week. I leave on Thursday or Friday. Thanks to Flavio Landivar. Hashtag he knows a lot about vacations for children. It's probably a pretty crappy hashtag.
It's a long one too.
It's a little long. It's a little lengthy. Yeah, it's a little lengthy. Marco Island. I've been there once, maybe, but I've never been to the JW Marriott there. He has a young child. I have 3 children. 2 of them qualify as young, and we're gonna go there, and we're gonna see if it's awesome or not. Oh my Lord. All right, last thing, of course, we'll end on a movie. Have you seen The Whale?
The whale?
Yes.
You know the answer before you ask the question, I'm pretty sure.
Yeah, I know that the probabilities lie in a big fat no, but I'm still gonna ask the question.
What do you give it? Siskel and Ebert, what do you give it?
Oof. I give it a 7.7 out of 10.
Is that positive or that's Rotten Tomatoes? That's many tomatoes I'm going to throw at the screen.
It's a little slow, but it's kind of expected to be.
God, you love slow movies.
No, I don't love them.
These 2 of us.
Oh my God. You're perfect, Brett. I don't care what Garcia says about you.
Right now, though, the viewer is looking at this and saying, my God, Brett does not get out of the house. And when he's in the house, he's not watching movies. What the heck is he doing with his life?
Oh, I could tell you right now, listener, he is on a Peloton or playing with his dogs or sleeping. Good morning and welcome to episode 34 of Talk Your Chart. My name is Marco Segreira, here with Brett Horowitz. We are recording on May the 17th. And welcome, Brett. How are we doing?
Come on, let's raise the energy a little bit. We've had some good statistics the last few weeks. Things are not as bad as everyone thinks they are.
No, yeah, I know. I'm sorry. I'm getting oriented. I feel like I haven't been in the office in too long. So I'm just like repapering myself to what I'm looking at. 1 screen, 2 screens, and we're ready. You're right. Economic data not as crappy as it's supposed to be. So recession or not recession. Who's supposed to go first? Me? Okay, I will go first. I wasn't here last Monday and Tuesday because I was in New York with our friends from JP Morgan. Every year they invite us to a cool little symposium where a bunch of smart people talk about things. And that, what you just said, was topic of conversation, kind of number 1, looking at economic indicators and all basically the data points that the National Bureau of Economic Research looks at. And the reality is, economy is not bad yet. And this first chart I'm throwing at you is, what about markets? And the R word is, I think, a good word to describe markets this year, right? Just resilient, right?
Yeah, would you say though there are a little more cracks forming? I mean, things are not as bad, but I don't think anyone's saying
look,
they're good.
Absolutely. Credit is tightening, which is one of the charts that I have on here somewhere. And spending is going to be coming down, right? If you look at personal savings, which we'll look at real quick, just to orient people on this chart with all the squares on it. Work your way to the right, you get volatility of different asset classes, and you get annualized returns from 2008 to 2022. And that one just to the left of that, YTD, is year-to-date performance of different asset classes or markets. And look at that, developed market equities, meaning stocks outside the US, top performer so far this year, which is in line with what you and I think is going to happen the rest of this year. and you'll just see everything else working its way down is generally positive. Commodities, not so, but they're coming off a hot and high 2022. So yeah, things are resilient right now. When's it going to take a turn? I have no idea. Could it? Sure, because earnings haven't collapsed as much as they're supposed to. But are the lows of down 25% from the highs from October 12th of last year? I think they are, but who knows?
Well, let's hope that this banking situation is solved, because thankfully there's no square for banking on here, because I've got a chart here showing the banking ETF index over the year to date down 38%. Ouch. Like, do you think that these last three big banks, Silicon, Synchrony, and First Republic, are the only ones to fail? Or you think there's a lot more downside?
Now, I think there's more to shake out there because of the exposure that regional banks have to commercial real estate. We've been talking about that since probably October of last year, and now it's getting a lot of buzz, the whole commercial real estate fracturing. It's getting so much attention that I almost feel like it might get priced away or resolved because everyone's looking at it so intently. I still feel like the risks that really matter and the risks that shock the systems are the ones that you don't see coming. Basically, you account for all the things that you define as risk, but risk is actually what's left over after you've counted for all those things. So I feel like the more we talk about it, the more it gets accounted for, but who knows? It could definitely be the next shoe to drop. But no, I think there's more stuff to happen.
Well, that's the more shoes that drop, the more the banks have issues, the less they're going to lend. And that certainly is not good for the consumer right now that's already spending up a storm and putting a lot of money in their credit card, and they need access to financing and capital.
Yes, so look at my second chart, right? My second chart is talking specifically about bank balance sheets and then credit. And if you look at it, actually, no, let's do two things. Let's look at the consumer first, and then we can roll to bank lending standards, which is what you talked about. Personal savings rate, which is your personal savings as a percentage of your disposable personal income, right? Which disposable personal income is the way you can spend on stuff. The big weird outlier bar is COVID. You couldn't spend, so you saved a ton. You have an average personal savings rate of 8.9 since 1960, and now we're down to 4.8, right? That's going to start ticking back up. As personal savings rate ticks back up, you get less spending. And what's 80% of our GDP? Spending. So
Well,
yeah.
We heard it yesterday with Home Depot's results. They said pretty much anyone that was doing any kind of house project is either done or wrapping up or doing smaller projects, because you just don't have the capacity to keep doing all the spending that you used to be doing.
Yes.
But it's expected, right? It was a boom for a while, and it's not surprising that it's happened. It's actually good, because the lower spending means prices can actually start to come down, because you now have some leverage now on the consumer side, less on the business side.
Yeah, and retail sales were down in March, and guess what? Back up in April. So good luck trying to reconcile that in your head. Next chart here is talk about banks and lending standards. I unless you want to talk about it, I can ignore the tier 1 capital ratio. It just talks about liquidity on balance sheets. The right side of this chart is what I care about more, because this is what people are talking about, and you can see it quickly. Tightening lending standards. That's it.
Well, it's a combination of more money, more banks not being competitive with their interest rates. So people are moving money out of banks. People who have money at the Schwabs and Fidelities and TDs of the world are putting more money into money market, taking out of cash. And so you're seeing, I forget the term that they use, but all this money is taking away revenue from the banks. And so you combine that with not wanting to lend as much because you don't have the cash and you have less of the margins. And that's a bit of a risk out there.
100%. What are you trying to say? Like net interest margin, like what they make?
There was another term I saw about people moving money around from cash to money market. I can't remember what it was, but we'll throw it up there at the end of the episode.
Okay, yeah, that's fine. So yes, that's happening. You leave deposits, so banks lose something that they use to lend. So you get less assets and you get a drop in your liability. So yeah, that's getting priced in. So what do you do with that? I don't know. But next chart.
You want to talk about effective funds rate, Fed funds rate?
It rolls right into it. Why have people stopped doing stuff? Because the fastest in history of the Fed hiking rates, and to a magnitude that is crazy. So it's so far, because again, they've paused, or so they said, but there's some people, Jamie Dimon to be included. And I say Jamie Dimon simply because he's a person that when the CEO of JP Morgan talks, people usually listen. Just about a year ago now that he said his famous economic hurricane words. That's yet to play out. Again, I don't think when he said that, he thought the next day something was going to happen. They're generally looking out into a longer horizon. What's interesting is JP Morgan, their talking points say a recession starts Q4 of this year, and they're expecting the first rate cuts to come in September.
Yeah,
The only way that happens, and this is another way to answer your question about bank stuff, I think the only way we get cuts in September is if this banking stuff continues to spool out of control, right?
Well, for me, it's clear. If I was a voting Fed member, I would stop cuts. I would stop interest rate hikes immediately. I mean, they're doing damage. We're seeing the damage. It takes time to do damage. You have a Fed funds rate now higher than the inflation rate, which is kind of odd. And
well, no, that's what you need. That's what we needed. Historically, the only time you cut inflation, you break inflation's back, right? That man.
We don't need to keep raising rates. It's already higher than inflation. Inflation is coming down. Let's leave it where it is.
Don't they know that, Brett? Like, I was at this JP Morgan thing and all these guys are hating on the Fed and like, oh my God, they're missing the obvious. It's like, but are they? I think all they're telling you is, I don't give a darn if I break the economy because I have the tools to fix that. What I can't fix is runaway inflation. So I need to smother it, that I might even throw the baby out with the bathwater.
How many
and then
months,
I'll just fix it later.
Marcos, how many months in a row have we now had declining inflation? 10, 12 months, depending on whether you're talking about core or headline. Like, it's happening. It's not like we're going to have a resurgence of inflation. There's no signs of that.
Yeah, I just think they're way more afraid of that than over breaking stuff. I think that's what they're telling us. Because, dude, like, you don't think they know this?
I just want to be a Monday morning quarterback because obviously.
Okay, at least you're honest.
It's what everybody wants to do.
Look, frame it right now, March 22 to May 2023, assuming they stop, 14 months, an increase of 4.8%. That's the highest change. It's not the longest duration. The longest duration was 36 months from December of 2015 to 2018. We know how that ended. Cuts, and they only raised 2%.
So are you not in the camp anymore, or I don't think you ever were in the camp, but are you getting into the camp of maybe a soft landing? Is that a possibility? Because we see the chart here with the economic indicators are not signaling a recession. You say it could be Q4. I've heard this every quarter for last year. It's possible it spills into Q1 of next year, in which case I win our bet on not a recession this year. Like, is it going to happen? I'm not sure.
I am firmly in the no soft landing camp. It's not going to happen, dude. I'll give you another stat. I didn't even bring this chart, but you're making me bring this chart. Let me get this employment situation up. When did it happen? So everyone's talking about US job openings and people looking for jobs. I don't have that other number, but it doesn't matter. There's 9.6 million job openings. It topped out at around 12 March of 2022, right? There's still a chasm between people looking
for sure
and people and jobs open, right? Well, guess what? Historically, it doesn't matter if there's a gap that wide. What has mattered historically is simply when you get a drop off, like a falling off the cliff of job openings, every single time, kind of like the yield curve inversion, you've gotten a recession. So it doesn't care what the level of job opening is, and it doesn't care what the level of job opening is relative to people searching for jobs. It just, when there's a big drop like that, shoes falls, recession's coming. So I think that's another indicator that this is going to happen.
Well, until it happens, we know that there's a high likelihood that the markets should rebound, given the statistics on what markets do after a crappy year. So I've got a chart showing that when the market declines more than 10% in a given year, which has happened 1, 2, 3, 4, 5 times, going back to the 1920s, you have an average return after that of positive 9%. And in only, one case did we have a negative 10% or more decline, followed by another decline the following year. So like, it's pretty obvious to me that you set yourself up for, even if things do get bad in the second half of the year, that you'll still have a pretty decent year if the averages are correct. And just throw a stat onto you, one more stat. Did you know that since 1929, there have only been 12 times where cash has outperformed both bonds and stocks in a year? Last year was one of only 3 times where cash was positive and both bonds and stocks were negative. Only 3 times.
Wow. And you're saying a 12 month, so rolling 12-month period is what you're saying?
Calendar year, yeah. No, this was calendar year.
There's no chart for that?
I don't have a chart for that, but
Oh my
we
God,
can
man, I
make
can't
some.
believe you. If it's not in a chart, it doesn't exist.
It's a stat.
That's a good one, because everyone's doing the whole, no, I don't want to invest. I'd rather just earn 5% in a money market. Well,
Yeah.
I get it until you can't.
Or match inflation. Why do I want to match inflation? I want to beat inflation.
Yeah. So it's, well, no, I get that whole thing. And you could do the 5-year idea, meaning so from today moving forward, I can invest in a money market or I can invest in just the S&P, to keep it simple. 5 years from now, which one do you think is going to have a higher return?
S&P.
Duh, it's too easy. The problem is, well, no, I'm going to wait for all the dust to settle. And then once I'm yielding lower on my money market, I'll shift over to the market. What do you think the market's done if rates have gotten cut?
Shoot to the moon.
Duh, you missed it. Oh, gosh.
Well, speaking of
Behavior.
missed it, I want to bring up one other chart here that I've got that maybe it's not obvious why it's up here, but I think it tells a story. So you and I, we won't name names, but we got an email from somebody who has an outside broker, and they were talking about how real estate looks weak, and you talked about commercial. We know residential real estate prices are coming down. We know that rents are going to come down because of all of the increases in interest rates. So there was a long explanation as to why, Mr. Client, you own this real estate fund. We're getting out of the real estate fund. This is why. Client comes back and says, that kind of makes good sense. I agree with you. But this chart that I have here shows that over the last year, this real estate fund is down 16% compared to the S&P, which is flat. So while it may have performed better or worse than other real estate funds, and we don't know all the ins and outs as to, when this was owned and the reasons why, to me, it's like you're choosing a reason to get out of something that is way late. Just like you said, when you look for the way too late. In this case, this professional advisor said, let's get out of this. I think they're way too late to have made that call. But, even professionals sometimes get it wrong.
Yeah, I know. And it's when you try to get a little too cute, right? And I don't want to say we're guilty of this, because I think the thought process here is what we're perhaps questioning. Like, process matters more than outcome. And this seems like a non-sustainable outcome because the process is flawed, because you're trying to make like active decisions with market information that don't seem appropriate. I wonder, and maybe we got this and I just don't remember, where the money went.
You mean after it was sold from the
Yeah,
real estate
exactly.
fund?
So you sell this, where did it go? And what was the thought process on the other side of it?
I'm
'Cause,
just
yeah,
not in love with the stories around. Like, I think I try my best when a client asks how something's going to perform, what's going to happen, to not make a story, because I don't know what the future is going to hold. But to act as if the information that I know now is going to impact things in the future, it's the surprises that we keep talking about. It's not what we already know. So to say, well, I think that, treasuries are going to be weak because of this or that, or stock market's going to go up because of this, that. It's just a story. I mean, it's just telling myself something that everyone says that makes sense because we hear it on the news, but that's not what's going to move that market.
yeah, I agree with you. It's tough. And again, the narratives sell more than facts do. So what are you going to do?
Well, I don't want to throw the client or the advisor under the bus because we don't have full information, but that's just my 2 cents take as to what I see was going on is a little bit of some faulty thinking and why we're going to sell something.
Yeah, I hear you, man. That's it. So we shall see. I still think the cuts in September that JP and other people are predicting, stuff's got to get real bad in the banking sector for that to happen. I think the Fed has put themselves in a position where they'll have egg on their face if they start cutting too soon, absent calamity in the banking system. So we'll
Well,
see.
they're clearly freaked out about what happened in the 80s. I don't think they're going to repeat that. I don't see this happening again.
He's looking over your shoulder, over my shoulder, right into your eyes. He's in Jerome's ear.
Soft landing, no recession. You heard it here first.
No, you heard it here first. Recession by Q4, because my life depends on.
All righty. Till next time.
Yes, sir.